Okay, so you guys hear me prattle on a lot about long-term care planning, but it's a very important consideration for us to make, especially when we're about to plan our retirements. And not only that, maybe you're not planning on retiring. Maybe you plan on working until, whatever it's your time to transition. But the most important thing is that you don't allow any long-term care needs to basically hijack and torpedo everything that you work so hard for. So it is my pleasure today to give you that information so that you're armed with it. So forewarned is forearmed. So what is long-term care? You keep hearing people talk about it. What it is it's assistance or supervision with basic daily living, activities of daily living. They're also known as ADLs, and things that we take for granted, eating, dressing, bathing, transferring, which means getting from one place to another, right? Toileting, being able to use a toilet, right? Getting on the toilet, right? Flushing and then getting back up and leaving. Continence, being able to control your urinary and bowel functions. So, this help with the ADLs, it may involve using skilled nursing or unskilled labor, or a combination of the two. So when I've mentioned unskilled labor, it's not implying that it's unimportant. It's just that you don't need to be a nurse to perform these duties. That's all. And unfortunately, long-term care is not covered by Medicare. Okay, so that's one misconception that a lot of people who are not quite close to claiming Medicare benefits, they're not aware of that they think, oh, well, it should be covered under Medicare. Yeah, it should be, but the reality is it's not. So questions that each of us should be asking about long-term care planning is things like, hey, who's going to take care of me in the event of an illness, an injury, or a disability? Is it going to be my spouse, my child, my grandchild? And can my spouse or other caregiver, right, not a formal caregiver, can they take time off of his or her work schedule, school schedule, general schedule to provide that care? And is he or she financially, physically, and I always like to add emotionally capable of assisting me with my needs? And will there be any generational or intergenerational effects of my long-term care needs? I mean, how's this going to impact, let's say that my parents depending on me for care, how's this going to impact their care if I'm not able to care for them, or my spouse, or my child, or grandchild? So one of the other questions is, how am I going to pay for my long-term care? And there are three main ways that we can pay for our long-term care needs. The first one is you can self-fund, right? You can do all that by yourself, or you can use a health-based long-term care insurance solution, or it's also known as traditional long-term care, and that's what people have known for decades about traditional long-term care. Or you can use a third option, which is an asset-based long-term care insurance solution. And what that means is it is linked with a whole life insurance policy or an annuity contract, right? It's also known as a hybrid long-term care insurance solution. So if you were to self-fund, your plans to use use your retirement assets for lifestyle or legacy could change dramatically, right? Because in order to fund your long-term care costs, you may need to liquidate your retirement assets, right? And you could possibly push yourself up into the next tax bracket. It depends on what the tax treatment for these retirement assets are. And also, it's just you know, you run that risk if, it does push you into the next tax bracket, you pay higher taxes. So the next option is health-based long-term care insurance, right? So that's, again, that's, traditional long-term care insurance. And it is a use it or lose it option. It's kind of like other types of insurance, right? You pay into it like car insurance. And if you don't get into an accident, fantastic, right? But, you know, you have nothing to show for it, right? Once you fund the insurance package. So, move some boxes out of the way here. Okay, and then the third solution is, you know, asset-based long-term care solutions. So, as I mentioned before, it's a hybrid solution. It's linked with a life insurance policy or an annuity contract. And if you don't need to use that long-term care, you actually have something left over. It could be in the form of a death benefit. If you need to use it, it gets paid out of that death benefit. And if you don't use it all, whatever's left over gets passed on to your beneficiaries. And they can get it generally income tax free, federal and state income tax free. And if absolutely necessary, you may be able to take a loan against the cash value of the policy. Okay, and I know that's a bit microscopic up there, but you know, this is to show a comparison or an example of what maybe a 65-year-old might have to shell out, right? Just comparing the different ways that they can fund their long-term care costs. So in the first scenario, if they were to self-fund, let's say that the long-term care costs were $765,000, about that, they would have to pay for all of that, right? So just think of funding like a severe long-term care need, $766,000. That's quite a sizable chunk. And, you know, with that method, you don't get a death benefit, right? But if you were to go the traditional route, like the health-based route, where you just fund the insurance, right? But you have nothing to show for it. Same, let's take a look here. Your long-term care costs are about $766,000, right? And your out-of-pocket costs, they're almost $257,000. So at least you didn't have to pay for the entire $765,000. And unfortunately with this, you don't really have like a death benefit. Now with the asset-based protection, you know, you can shift the risk, right, to the insurance company. Same thing with the traditional long-term care one, but with this, at least your premiums are guaranteed not to increase. Okay, you can keep it stable. I forgot to mention with the traditional long-term care solution that there's a potential for those premiums to increase. And with this, jumping back to this asset-based long-term care solution, you know, you could potentially pay $19,000 less. And plus you may have a long-term, you may have potential death benefit left over, right, if you don't use it. So if we were to see how it stacks up, you know, this is a visual representation of what I just shared for that example. So if you were to self-fund, right, it would be $765,000, right? If you go the traditional route, you know, it claims a little bit less of your assets. And if it's asset-based care, right, it claims less than that. And then you could potentially have the death benefit left over. So how do we activate our long-term care benefits? So the point of activation is when the policyholder cannot perform 2 of the following 6 activities of daily living, right? One of them, and this is for a period of at least 90 days. So if we can't perform 2 of the following 6, one of them is eating, right, bathing, dressing, transferring, toileting, and continence. Or if your healthcare professional deems you to be severely cognitive impaired, then that's when the long-term care benefits are activated. You just need to communicate with your carrier.
Will they fight that? Will they like dispute it?
The insurance carrier,
Yeah.
they shouldn't, as long as you document everything, as long as you contact them. Got to keep the lines of communication open. There's like a claim process, so.
Will they deny the, can they like I've been, some insurance claims get denied by the insurance?
They shouldn't get denied, as long as there was no line on the application. And you adhere to the claims process requirements. Yeah, and you raised a really good question, because I'm going to show you that they do indeed pay those claims. So as we progress through the presentation, the information, I'll share that with you.
What is transferring?
Transferring is when you're able to get from one place to another, like moving from your bed.
Oh,
to
in the house.
kitchen,
not it,
yeah.
you know, to the-
kitchen or to the bathroom.
Getting around.
Yeah, exactly. Like, does this person need a walker, right, to move around? Or maybe they're not even strong enough to get up, use that walker. So, the whole purpose of long-term care is just so that you could keep the retirement assets for your lifestyle. And then, maintain your assets, allow your retirement assets to grow, so that if your intention was to leave something to your beneficiaries, at least it's there. It's not being usurped by the long-term care costs. So in order to do that, what you want to do is you want to develop your plan. At least you don't have to, maybe it might not be to spend any money, but you want to have a plan in place and make sure that your loved ones know about that plan, right? Just asking the same questions that we looked at a few minutes ago. And you want to review it periodically, right, on an annual basis, so that, hey, just in case any laws change or anything like that, you're always like on it, you're always updated, right? And you're not caught by surprise, and neither is your family. So another good thing about long-term care is, or having these long-term care solutions in place, is that you may be able to deduct some of your long-term care insurance premiums, and it depends on what age band you're in. And another great part is, you guys might have caught this, is that any long-term care benefits that aren't used, right, from the third solution, it can be distributed as a death benefit, income tax free, federal and state income tax free. And here are the 2022 tax deductible limits, especially if you're self-employed. Let's say that by December 31st, 2022, you're 40 or less, right? This is what you could potentially deduct off of your taxes.
So,
Yeah.
What point does that kick in? What, I'm not clear on.
Oh, these are the premiums.
Also the premiums.
Yeah, these are the premiums. You can deduct your premiums off of the taxes. But these are the limits right here. This is
Right.
as much as you can. As you can see, the older you are, the more you can deduct off of your taxes.
And this is for your hybrid model.
Yeah, this is for the hybrid model. I believe even the traditional long-term care, you can deduct the premiums. So what you want to do is you want to loop in your tax person, right? Your CPA, your tax accountant. Maybe some of you have your trust attorneys do your taxes for you. So you want to loop them in, let them know that this is what your intention is, that hey, you're getting long-term care, and so that they can factor this in, right? Everybody's on the same page. Okay. And another thing that if you guys want to geek out on this and then find out how long-term care needs can impact wealth, there's like a 50-page PDF that you can read how long-term care needs have affected, well, we did a study of this. This study was commissioned by the US Department of Health and Human Services, and it was pretty helpful. I got a lot out of reading that. And so, just wanted to, let you know that, hey, everyone's situation is a little bit different. So you want to loop in your, it's a CPA, tax professional. We work with other financial advisors as well. So yeah, Ben and I work with other financial advisors and CPAs, tax attorneys. So if you ever need us to talk to them, if you're interested in looking at it, see what that means for you, we're happy to help. And here's my contact information. And again, if you need to, we help you find the right tools to build a strong financial house. And I wanted to answer Aaron's question real quick, because you were saying, what if they deny the claim? Yeah, let me go ahead and look for it. I'm gonna have to stop sharing so I can go find the file.
Probably Elon, don't.
Yeah, you call Elon. Yeah, Elon will get to the bottom of it, right? Because you're experienced dealing with insurance companies.
Yeah, it's mainly with, again, property damage claims, stuff like that, not,
Yeah,
these types of claims.
and I
but
bet you
sure.
know somebody who could,
Yeah,
work
yeah.
on a claim like this, but still, just to address Aaron's question, like, what if they deny it? Well, they can't, and I'll show you where. Not only couldn't they deny it, they had to pay for like a decade. Somehow this person who needed long-term care needed it for a decade. So go ahead and find that information to show you.
We're looking for that question.
Yeah,
What's the average length of time somebody is on long-term care?
it's like 3 to 5 years.
3 to 5.
Yeah, 3 to 5 years, and I'm just gonna share the.
But if you start the insurance early, let's say at 40, the premium should be low. And
Yeah, exactly. Yeah, the
And
premiums
that's
are
the-
lower, like, the age bracket.
the amount stays the same throughout.
Yes, it stays, this is for the third option, right, the hybrid option. It's locked in, it's not like traditional long-term care where the premiums could increase. So, you could specify, hey, I want to fund this for 5 years, or I want to just put in a lump sum, or I want to fund it for 10 years, or I want to fund it to age 65 or something. You can do it. You can certainly select that option. Yeah. So there was something here that I want to share here. I'll be able to find it. Yeah. So does anyone have any other questions right now, or?
Are the companies that you use, I know, I'm sure there's different companies.
Yeah.
Who insures them? Like, say, I open up a company, and I do this, and then all of a sudden I go bankrupt. What happens? Is it federally insured?
So the insurance companies, they are regulated by the state, and, the state usually has a reserve that covers some of, like an insurance company that is insolvent, right? Then another insurance company will have to come in and buy those contracts.
Okay.
Yeah.
Okay.
That's a very good question.
But aren't a lot of the players, the normal big guys in the industry, like the John Hancocks? And
Yeah,
people
they're
like
they're
that?
big guys, and and companies that have been around for quite a while, like the company that one of the companies that Ben and I work with, they have been around since the 1880s. Yeah, so.
Almost as long as you, Peter.
Maybe 6 months or so.
With the hospital act. Hospital.
Holiday fire.
It's like we love to throw those barbs around, right?
Long-term healthcare.
Yeah,
That's a long term.
yeah, the 1880s, so. Yeah, and, you know, you can always apply, with your spouse, right? So as long as your spouse is, there's not like more than a 25-year age gap between you,
Dang.
then. Yeah, then, you know, you can apply to get.
Good idea.
It'll be
That's
more-
got our planning process, right? Start right away. You got our attention.
It'll be more cost effective if you guys apply together. Yeah, so. Yeah, and
We woke up immediately after that. I have to,
You guys
I have to add a goal to my whiteboard. For next year. Healthcare.
You're quiet.
yeah,
Right.
do you guys, let's see, I was just gonna ask, remember, we joked a little bit about, Steve, remember, you wanna buy a home with your honey or your girlfriend or something like that, and it woke everybody up. I think some of
Should
the,
have started with that punchline. There you go.
yeah,
Rad.
there was something where, yes. So to answer your question here,
And then that.
yeah, so,
And my parents were 36
Yeah.
years apart.
Yeah.
really,
Wow.
Oh, yeah?
Who?
The parents.
Oh, yeah, that's right.
That's a long
You mentioned
distance.
In Brazil,
Your dad
if you
should
do
go on
that
the
in
war.
Brazil, you go to jail.
Oh, it's
minors, right? Well, you know what I'm gonna do? I'm gonna email you guys the statistic, right, that shows, you know, payment of the claims, how, like, the longest claim that they ever paid, like 14 years, 10 years, you know, it would have bankrupted the family of this person. Yeah,
No, you finish and I just want to ask a question after.
yeah, so I'll send it, I'll email it to you, just like the glossary for the terms, that way you guys are here, you know, you can ask questions, shop around. Yeah.
So I know one of the key things that Ben, when we had conversation.
Yeah.
One of the key things that you guys are able to provide is this. It's not an expense, it would be creating an asset.
Right,
Even the long-term insurance,
yeah,
it becomes an asset.
Yeah.
Just like you buy a home or whatever, it becomes an asset that you literally get the money back,
right,
or you're able to, if you have a business issue, you can take a draw against it.
Yeah.
So
exactly.
it works with the long-term.
Yeah, in this particular, it's almost as good as what you were talking about, because you were talking about the
Right.
becoming your own banker concept.
Yeah.
And at least this third solution, it is an asset, right? Because you actually have something to show for it. If you don't use it at all, good for you, right? Then when you pass, you know, that means that the benefit that's in there, it gets passed as a death benefit to your beneficiaries. Yeah,
So it's
that's an
a
asset.
combination of life insurance, disability insurance.
Yep.
And other things, you can all bundle it together. And then
Yeah.
into the similar type of plan, and as it grows, that's your asset,
That's right.
you know.
Yeah, so we also do work with a company that offers disability income insurance, and that's in case you're working, right, and for some reason you either become ill or injured, suffer some kind of disability, at least it'll pay you some income, right, 65% of what your monthly income is, your average monthly income. But yeah, in this particular case, yeah, it's long-term care. And, you know, this is gonna be especially relevant to people, especially, the statistics show, according to the Department of Health and Human Services, that 70% of the people over the age of 65, they need long-term care.
That's
So,
50%.
yeah, it's pretty high. And
At some point in their lives, or?
yeah, at some point in there, so this is a federally commissioned study that they did, and yeah, it's really high, and you're gonna see that, you're gonna see a lot of that.
Tony, you said
Yeah.
that this isn't covered by Medicare.
Right,
Now, to me, it seems that Medicare should cover something like this.
should.
I don't have confidence in the government. Um. Doing Medicare reform and including this, but if they ever did, and long-term care was included in Medicare.
Yeah.
How does that affect your business model?
That's a really good question, and it depends on whether you trust the quality of government provided care.
Yeah.
I mean. It just depends on whether you. Hey, you have confidence in the type of services they provide. They can barely provide their services now.
You might have to have an ex-IRS agent changing diapers.
Yeah.
And they're armed now, by the way.
They've always been on. They've always been on. Yeah.
It's not so much.
But now
it's
that's
not so
loaded.
much-
They finally got the money to buy the bullet, now you're in trouble.
I mean, so I guess they're beefing up like the IRS agent or teams, and supposedly they're not going to audit, middle class people, and they're gonna go for the
Yet.
high income. Yeah, right. They wanna
Not a chance.
Got the foot in
Basically,
the door,
grab
that's all it
us-
needs.
shake us until the change comes out, but
Well, it's not, I don't have it's not a trust issue about what their quality of their service is. It's just the idea. If they come up with the idea that the government's gonna provide long-term care, then these other companies will come and it'll become more affordable. I don't know, what was it, 15 years ago? If you had cancer, it wasn't against the law for an insurance company to dump you.
Yeah.
well,
But since the Affordable Care Act is passed,
they can't
now
turn
they
you
can't
down.
dump you if you get a serious disease.
Yeah.
So it's just the idea of that coming along, happening, then everyone's thinking that way. Now, if the idea that long-term care should be covered by the government, that's a boost for us. I mean,
That
I'm
would be a
hoping that
boost.
everyone else would think that way, and sure enough, it may happen. I don't
I
know,
mean,
getting off.
yeah, I mean, supposedly, there is enough in social security, but we keep hearing about how it's gonna run out by 2035, which is supposed to be like the year that that I'm close to retirement. So, yeah, happy birthday to me, but
They've been telling us that since I was a kid.
yeah, that's right.
Like when I was a kid, 1980, it was gonna run out, so.
Yeah,
So it's just all fear.
yeah, that's true. It is
They can
very-
print more money.
So
Yeah, it's true.
there are different levels. So say you're in your home and you just need help with some, coming in during the day.
Mhm.
And so that expense might be much lower than say assisted care. Or on the claims, can you get like a just enough to cover it? I mean, I'm sure there are different expense levels, and are you
Yeah.
basically drawing down on that whole life
Yeah,
policy?
you're drawing down on that whole life first, so you spend the whole life, that base policy down
Okay.
first. And of course, you want to protect like a rider, right, to continue the benefits. So you can continue it for 33 months or 50 months or a lifetime. It's called, continuation of benefits rider. So you guys want to purchase it with that COB rider.
Okay.
And to build on Paul's question,
Sure,
are we saying then, I thought I heard you say earlier, there's like a list of so many items that all of a sudden now you qualify as long-term care, is that
Correct.
right?
yeah,
So,
2 out of 6.
so he's saying, hey, if I'm just peeling off one of these items, we're not necessarily digging into that policy or
Correct, yeah.
pulling the money out of another piece of it, which is the cash value, is that what you're saying?
Well, if you.
Because in other words, if somebody progresses into the full long-term care situation, that itself could be another 2-year journey.
Right, that, I guess that was my question, and that you just, so it starts out, smaller expenses, but
Yeah.
as time goes on.
Yep.
Those expenses probably ramp up until ultimately maybe you do have to go into assisted living. And then that gets very expensive. So are you able to access it to cover certain costs, and then as it ramps up, it
Yeah.
increases.
Yeah, as long as you
Have the proper
satisfy,
insurance.
yeah, yeah, exactly. As long as you satisfy those 2 out of the 6
Got it.
ADLs.
Yeah.
And, you know, you bought a rider that covers a long enough period, you should be fine. And they operate on the reimbursement basis. It's not a capped. rate.
Got it.
They
Okay.
reimburse you for the expenses, so keep good records, right, keep your receipts. And, you know, you submit it to the claims department and they'll process.
Which would be a family member or somebody else helping you, because if you need this help,
Yeah.
you're probably not in a position at all. to
That's
track
true.
any of this stuff.
Yeah, that's true, you'll need to,
Right.
loop your family and your professionals in, right, so that everybody's, you know, everybody knows what they need to do. Yeah, so, that's all that there is, and Aaron, I'm gonna send everyone the information. And, that way you guys are prepared, and that's all I have for today.
Very good.